Well, hello everybody. Welcome to P.B.M. Money. Today we're going to talk about leveraging your way to wealth. I want to talk about what leverage is not, what leverage is, when it's appropriate to use it, and how to make yourself wealthy with it. When I was young and I got into the market, everybody kept telling me, OPM, OPM, leverage everybody else's money and you'll be wealthy. Well, I did. Didn't work. Because they didn't tell me what the true definition of wealth is. So it doesn't mean no money down. It does not mean no payments of your properties. Doesn't mean buy cheap properties. It doesn't mean buy lots of properties. You will know that you are ready to start leveraging your way to wealth when a couple of things are happening. Number one, you've got a minimum of 2 or 3 or 4 properties, half of which are paid off. Each rental property will have whatever reserves you determine to be safe. I determined $10,000 per property. That means every dime that property makes for the first 2 years goes into a savings account until we get to 10,000. Then we start pulling cash out and put it into our investment account. And that does a couple of things. Number one, it makes sure that we have a minimum amount of cash on hand so that we can handle most anything that comes at us. It might set us back, but at least we'll have the cash, we'll be prepared. Because one of the things I've learned is that most people fail because they are underfunded or underfinanced and overextended. And I, when I was young, was overextended because nobody explained to me the fine detail of leveraging, which is what I'm going to tell you about today. You also need to have a good credit rating because we're going to be doing a lot of refinancing here, okay? So once you meet these criteria, you are now ready to start leveraging your properties. Now when you buy your properties, to be able to control a $100,000 piece of property with $20,000, that is a form of leverage. Don't misunderstand me. But that's not how you leverage your way to wealth, and I'm going to show you now how to do that. So in the first year, remember in our example here, we're going to have 4 little houses, 2 of which paid off, 2 of which are financed. We're going to assume that each one is worth $50,000 and that any properties we buy are also going to be worth $50,000, okay? So year one, when you start this process, and yes, you should start at a predetermined time, not just right out of the bat, because everything that you've done to get you to this point, we're going to continue. As an example, for me, $5,000 per property per year is what we pull out. All right? We, as an individual, I save about $15,000 a year of my income. So that's not going to change. What's going to change is how we handle our properties. The first year that we start this, we're going to take one of the paid off properties and we're going to put a note on that for 80%. So we're going to pull $40,000 out. Now, one of the reasons that this is so powerful and so important is because all this money we're about ready to use from the properties is tax-free. Loan proceeds and insurance proceeds are non-taxable. So up until this point, we have used taxable income to build our wealth. From this point forward, the majority of our cash that we're going to use to build is non-taxable income, and that's powerful. That is more powerful than anything in the market, anything, all right? That's part of the leverage. Okay, so we pulled $40,000 out, and I'm going to talk in round numbers. So we're going to take $10,000 of that and go buy another property, which means we're going to put $8,000 or $10,000 down. We're going to have our fifth property with a mortgage on it, and now we're only going to have one property that has no mortgage on it. The other one, we pulled $40,000 out. We used 10, we now have 30 left over. Are you with me? All right. So we take that 30,000 and we put it into our investment account. Now, for that year, we're going to continue to put $5,000 per property, which is going to be $20,000. Then we're going to put a $15,000 that we save each and every year. And that's going to give us a total of $65,000 plus a new property from our normal, ordinary, everyday investing, okay? The second year, again, we continue in our investment account to put $15,000 from our savings, $20,000 from our real estate, and we had $65,000 left over from the previous year, which is going to give us a total of $105,000 after we refinance our last house. So remember, we now have 5 properties, 4 with mortgages, 1 with not. So now that last house, we're going to put a mortgage on it. We're going to pull $10,000 out. We're going to go buy another property with the mortgage on it. We're going to put that $30,000 remaining into the pot. We are now going to have a total of $105,000. Okay? Now, I want you to take $45,000 of that and go pay off one of the original 2 houses that you had that had mortgages on them. So now we're going to have 2 new homes plus 1 that we just paid off, and that's going to leave us a total of $50,000 in cash. Now, when I say leverage, I don't mean just in real estate. Now, from our personal savings, we have $30,000, $15,000 per year for 2 years, right? All right. We have 1 house paid off. We now have a total of 6 homes, 5 with mortgages, 1 without. And we have $50,000 in cash. $20,000 of that is which we got from refinancing. I want you to take that $20,000 and go put it in the market, because that's not really your hard-earned money. That is money you finance from the properties that the tenants are now paying for. So go put it in the market. Now, if you don't want to fool with the market, that's fine. Put it into an S&P 500 index fund and just leave it alone. Put $20,000 in there and ignore it, forget it, go away. All right? So we have financed now for 2 years, refinanced for 2 years. We've leveraged 2 properties. We went from 4 properties to 6. We went from 2 with no mortgage to 1 with no mortgage. We have $20,000 in the stock market, and we have $30,000 of our savings sitting in the savings account. So now what do we do the 3rd year? We do it again. We go to the 1 property that is not financed. We pull out a loan. We take $10,000. We go now buy another property. That leaves us $30,000 in cash. We mix it with the $30,000 we have. We now have $60,000 in cash. We now have 7 properties, all of which have loans on them. And now they're starting to generate $5,000 a year on the 3 houses that we have since bought. So now it's up to $15,000 on top of the 20. At this point, I want you to take $45,000 of the $60,000 and go pay off one of the properties. And then I want you to take a year off. And in that year, I want you to start accumulating cash. And as soon as you get to about $60,000 again, I want you to pay another house off. And that should take less than a year, because now the houses are now generating $35,000 a year, plus $15,000 of our savings. That's $50,000, plus the 30 we had, which was $80,000. Are you with me? So now we have 7 properties. 5 have mortgages, 2 do not. We have $20,000 in an S&P 500. 3 of those homes have been leveraged from properties we had. We still have our original $45,000 that we have saved, and we've used the property to fund all the growth. So in 3 years, we have leveraged our property to buy 3 new homes, each generating $5,000 per year. That's $15,000, plus the $20,000 we have in the S&P 500, plus the 2 homes we still have with no mortgage on it. You see how that works? Start over. And you just keep going. Now at some point, you need to make some decisions. Do I refinance 2 properties and buy bigger properties? Do I sell a couple of them and buy bigger properties? Do I continue with single family? Do I move up a little bit and try duplexes? But this now gives you options, because you're still doing the same thing you always were. You're still saving your $15,000. That's assuming that hasn't gone up. But you're using the growth of the properties. And every time you refinance a house, pick a percentage at the end of the year with whatever's in your investment account. Pick a percentage and put that one into the stock market or the S&P 500 index fund. Because everything that you do from this point forward is going to be leverage. And just to make sure that you're not using your money, at some point, once this gets going, I want you to pull your $15,000 a year out of your investment account and start putting it into your own savings account. That does not mean you go blow $15,000 a year. That just means at some point you can now take cash money from your personal stuff and go buy a house for cash. But when you're using leverage to go do and buy and grow, never pay cash. The only ones you pay cash for are the ones that you finance over time. So if you're saving $15,000 a year and you need $40,000 down, then I guess you're going to buy one every 2.5 or 3 years. And as you go on, that'll increase because you'll be saving more. And you'll be buying more with your investment account and leverage. So now instead of 1 a year, you'll be buying 2 a year. At some point, you'll be buying 3 a year. That's leverage. Now remember, from this scenario, we started with 4 little homes. Only 2 of them paid off. 3 or 4 years down the road, we're up to 9 or 10 homes. 3 of them paid off. Money's sitting in the stock market. Loads of money sitting in each one of these accounts for these homes, $10,000 in my case, per property. Plus they're now generating $40,000 to $45,000 a year just in cash flow. You see how that's the leverage where you grow. That's when it starts making a big difference. That's the leverage that you use on real estate to help you grow. Not just in real estate, but in any other investment, like the stock market. And you just keep doing that over and over and over. And at some point, you can take your personal stuff, put it into a savings account, and start your own on the side where anything you now buy, you don't finance. At this point, you pay cash. So now, instead of having 2 or 3 that are paid off, that you have leveraged and paid off, you can now have 3 or 4. So every couple of 3 years, you'll add one more house that is completely paid off, which every 3 or 4 years doubles the amount of houses you're able to leverage, which means you'll be doubling your investments every 3 or 4 years. And that's the power of leveraging. And that's how you will leverage your way to wealth. That's all I wanted to say. It's a term most people don't understand, and even if they say they do understand, they don't understand how to use it, how to leverage it, and how to gain from it. Now you do. Have yourself a great day, a great week, and happy investing.